Welcome to the Meat and Potatoes podcast. We're here again with Mike Peregrina, who is the co-founder and CEO of Homey. How are you?
I'm so good. It's good to be back. Great to see you.
Yes, a little two-parter.
Yeah, I'm grateful. I feel special.
There's not a lot of them.
I heard.
And this all started because we were jamming out a little bit before, and I'm like, oh, there's enough here for two.
Yeah.
And in the previous one, we talked about the founding story, the idea. We talked about your upbringing. We talked about the early days, and it kind of tapered off into 2020.
Yeah.
Because a lot's happened since then. So the second part will be 2020 to now, 2023.
Yeah.
And this podcast will probably come out in June, so June 2023. So we can throw out some buzzwords like we did in the last one. You've got COVID, pandemic, inflation, interest rates, war, frothy job market, stock market retraction, Silicon Valley Bank, First Republic.
Yeah. Well,
Have fun.
Man, I got to take a breath.
Yeah.
So much has happened since 2020. So let's see, 2020, end of 2019, we raised our Series B. So we partnered up with a great investor and we had capital, which was really great. Going into 2020, that first quarter, we were just, going through, the selling season and buying season of real estate. Super excited. And built a really good team, feeling good. And then COVID happens, right? And that was middle of March and the whole world shuts down. And that was really interesting because, it was big panic and pandemonium, unlike something we've ever seen, a black swan event, right?
Yeah.
And it felt a lot like 2009, 10, 11, et cetera, right? And I had lived through that. That's where the founding story of Homey comes from.
Yep.
So it felt somewhat familiar and sort of a little bit of muscle memory then. At first reaction, we wanted to, lay off people and preserve capital and say, how deep is this going to be? And there's a couple of things that I've learned over time in real estate. And one is nothing ever goes to zero. I mean, even in the middle of the pandemic, absolutely transactions dropped for sure. A couple months, 3 months, maybe, but then they spiked right back up. Right. And I felt like through rigorous discussion at the management level with our board, with our investors, what have you seen before? What are our peers doing? Who are we talking to? Consumer businesses are obviously fairly different than, B2B businesses. But something in my gut said, remember 2009 and 10, right? What happened in Las Vegas in the deepest recession since the Great Depression, transactions, and I'll say only for context, transactions only dropped about 40%.
Yeah.
That's crazy, right? In the deepest recession since the Great Depression, spots like Phoenix and Las Vegas that get hit really hard, they only dropped about 35 to 40%. That was really, really surprising to me. And I said, okay, well, worst case scenario, we kind of have a benchmark or a watermark. If that happens, what should we be doing? And I felt it was like a perfect storm for Homey. And after rigorous discussion, we said, look, we'll maneuver and we'll run the business week to week, which is really, really hard to do. And I remember when, the government started, doing a lot of the aid programs and all that. And I remember working out of my oldest son's bedroom for 3 days straight. Like I wasn't even taking a shower. We're trying to, okay, here's our cash. Here's what we're doing. Here's what we're closing. And given that the sell side was one of our superpowers and everything was fairly virtual, oh man, we kicked butt. June of 2020, we did like almost 500 transactions, most of those sell side. And I'm glad we were able to have the courage probably, but I think the confidence and courage came from a lot of that rigorous discussion and preparedness for sure. And then on the buy side, our buy side conversion went up because, now you couldn't go see 10 homes, 11 homes over a weekend. You had to condense all that to maybe 2, right? For health reasons, literally life or death reasons. So we were very thoughtful. We added a lot of technology around, 3D modeling for the homes. That really helped condense, okay, that, spatially that works for me and my family. Our agents and our employees, I mean, they honestly put their life on the line. There was conversations and the way everyone rallied together. I think there was a company here that started producing at mass scale, hand sanitizer and buckets. And it was just, It was beautiful to see all of, the community rally together. And then we were well on our way. We had, market share north of 5% in Utah, which was crazy. And then that carried us, through the middle of 2021. And then that's when things started changing. So every year we've been doubling revenue ever since. And the crazy thing is, our strategic moat is what I like to call is our attachment rate, meaning our crossover rate from our mortgage, our real estate side to mortgage, our real estate to title, our real estate to insurance, north of 92% now, which is incredible. That started getting better and better. So we started just hunkering down and focusing on our strengths and our opportunities, and then everything else kind of became noise. But our revenue per unit started increasing really fast. But then we didn't see this then, but we saw it now. Then transactions started decreasing, right? Then home price appreciation started increasing a little bit too fast for our liking. And then inventory started detracting. And then you had a lot of institutional investors coming in and buying homes cash. 1 out of 10 homes maybe is a cash offer in Utah. Then it was 1 out of 4, right? So 25%. And then, if you kind of take a step back and look at Homie's demographic, we have 30 to 35% or so are first-time home buyers and first-time home sellers, and as interest rates started creeping up because the cost of capital was so cheap, and investors started paying cash for these homes, the first-time home buyer and seller started getting priced out. And then interest rates rose a little bit more, and then the market contracted. And then at the end of 2021, the management team and we came together and said, okay, we're going to raise another round of financing. We'll go in, the beginning of 2022, revenue per unit is increasing, a lot of wonderful things. But then the market started shrinking again and again. And then, we went out to market, and it was unlike something I'd ever seen before. I think we had 9 meetings, and every single one of them were like, you know what? We're just not going to deploy capital right now. Something feels wrong and off, especially in real estate. And then we heard it again and again. And, Johnny and myself looked at each other like, oh, crap. Like, that never happens. There's a little bit of, groupthink and, common questions that are asked. And then it was like the fear kind of shook in. And we said, okay, we're burning this much cash. Transactions are declining. Revenue per unit is increasing. Let's identify what's break even, what's profitability, what needs to be true for that to happen. And then the market just got worse. It started shrinking literally like 45% year over year. And then interest rates just kept on rising. And every time the Fed sneezed, interest rates rose. And then that first-time home buyer and that first-time home seller, right? It's like, man, yeah, I have a little bit of equity, which is great, but I can't unlock it because, one, I have a 3.5% interest rate, or even 4. But then now I'm going to pay 5, 7, 8, maybe, et cetera, on interest rate, the cost of capital, and the monthly payment, which is so high. And then that was 35% of our transactions, and boom, just like that, we that started shrinking, right? And that was really painful to see, and then the inevitable came, right? You do the math, and then it's kind of stares you in the face. And then as a founder, you never think you're going to go through that piece, right? And then we went through a reorg, we laid some people off, we had some reductions in force. We strategically picked, where we're going to go in terms of our expansion markets. We peeled back, and then we said, what are our strengths and our weaknesses? How much cash do we have? And man, the support from our investors and our employees and the sacrifices that they've made and laying people off. And, one of the things that I just felt like, sometimes we talk about culture and building a culture. And at Homie, I like to say we don't have a culture. We are a culture. We behave the same way between 8 and 6. And when we clock out, we're the same people. We don't just come in and clock out. Everyone believes in the mission and the vision, and saying goodbye to people. We made a lot of mistakes along the way, but hiring great people is the mistake that we didn't make. And that's what made it twice as hard and painful. And, I remember the first reduction in force that we had. I don't know that I've ever cried so much in like the last 20 years. And it was painful. It was really raw. It was a wound that was open, and you didn't know if it was going to close. And, they tell you, and you read all those articles, and like the Sequoia, cut deep, go cut deep as you can and go. But you can't predict the future, especially in consumer businesses, and we would have left a lot of revenue on the table if we wouldn't have done a handful of them. And it was painful.
Yeah.
It was numbingly painful. And oh man, I'm grateful to my wife, Mallory, for her support, and, my family on both sides, and our investors and the management team, and Johnny. And the mental health thing was really, 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 really stressed, and you make those sacrifices, and now we're in a great position and better, but it came at a sacrifice, and that's something that I'll never forget.
Yeah. Those will be scars that are
Man,
kind of eternal. So on my side, I've never worked for Homie. And I'm sitting there. I'm like, I don't like this game, but I have to play it. The COVID game, right? Like it sucked for us here. Like all we're doing is talking about like economic impact and COVID. And I start to get postcards saying, I'll buy your house.
Yeah.
And getting people knocking on our door.
Yeah.
I'll buy your house. Lots of that happened, right? And I'm like, oh, what is going on right now? And my wife does not like our current house. I could live in a tent and be perfectly happy as long as I got the wood shop and a yard. But she's like, let's go look at these houses. And I'm like, okay. And zero intention to do anything, which irked her. But we're going around and I'm like, oh, we're all playing this weird game right now where it's unless you've got like a rich mother-in-law that's going to give you the money, we're just trading.
Yeah.
And I'm like, well, okay, let's sell it. She's like, we'll make a ton because we bought it for cheap and interest rates were low. I'm like, cool. Then what? Then what? Then what? Then what? And I can imagine like you guys in that industry. Then what? Then what? Then what? And it was weird. And the stuff we've been saying for the last 30 years in Utah, like it's cheap and it's affordable and gone.
Yeah, not anymore.
Bye. You know, our junior interns and staff, like they should have been buying. Can't.
Yep.
No, not even close. Yeah. And you're just watching this whole like these history making things, and there's not a damn thing anyone could do about it.
Yeah.
It's like, you know, interest rates and inventory, and you're like, okay, roll with the punches. So from where I was sitting, I was like, there's just some chaos and carnage. And obviously when you guys were on the inside, it was infinitely worse.
So bad. It's so bad. It's really sad to know, like right now, contracts that go under contract, if you look at the market, it's about 55%. So 55% of contracts that go under contract in April will close in May. That's pretty bad, right? That's almost half that won't close. At Homey, we follow that like a hawk, right? And we're roughly 80%, 85%, which is pretty good. You know, historically, it's been north of 92%. And it happens sometimes that, you know, they fall out of contract, they get back in and they roll out. In Q4, we saw similar things happening, but we saw our customers on the sell side, especially, and on the buy side saying, on the sell side, you know what? I may just rent my home. I'm sitting on a 3% interest, 30-year fixed mortgage. That'll be double, and then I'll also pay double for that house. Yeah, I can roll over the equity, but it's too expensive. And then we saw the market, you know, was freezing. And then people were renting or people were just pausing. And then on the buy side, same thing, right? And it breaks my heart because, you know, you get pre-qualified for a mortgage, you shop around 2 weeks, 3 weeks, 4 weeks. You got to go through a full underwriting process. Well, what you thought you qualified, you know, 45 days later is no longer the case, you know, and watching first-time home buyers or any buyer not being able to qualify, it just breaks my heart, you know, and it stinks. You know, for us, Homey's vision is to make homeownership easy and affordable for everyone. Now more than ever, it's worth fighting for. It's been that vision has been threatened more than ever, and it stinks, you know. And there comes a point where rising interest rates are a barrier to entry. Well, I can't afford anymore, but there's still demand. There's a point where that continues to rise, and then that's a barrier to exit, right? Same thing that you were just describing. You know, but things will continue to thaw out going into spring and summer. It always happens. That bell curve is the same no matter what economic climate we're in. I think the height or the watermark of that bell curve is what changes, you know, and, you know, at Homey, we love to make sure that our customers have a great experience, and we love to see their faces when they see, I saved that much money. I made that much more for my house. I qualified for this because of the, you know, rebate that we provide. Man, one of our agents was in the office yesterday, and they asked for one of our agents. Okay, come back to Title. I walked them back there, which is really cool. They don't know who I am, and they're just so excited. And I'm just, you know, vicariously living through them. And I said, wasn't that you know, the rebate awesome? And they said, that's the reason we were able to afford the house. Yeah. And that's a big difference. And first-time home buyers, I was just so happy to see that. It was really cool.
Absolutely. Because it's a big rebate.
Yeah, it's huge. 50% of the buyer commission. It's huge. That's thousands and thousands of dollars.
Yeah. And it moves the needle.
Absolutely.
Yeah. yeah, there needs to be a class for people that care and don't care about like these cause and effects, right?
Yeah.
With you guys, like you've mentioned previously that you're a numbers guy and a data guy, right? Even if you're not, right? Like, what are these things called? Interest rates. Oh, if they go up, this is what happens. Well, what about this? What about that? And you guys have had to like adapt to all of these punches throughout. And you know, we talked a little bit about you guys like being vertically integrated,
Yeah. Yeah.
which is additive and beneficial.
Hmm.
Even, you know, like if there's just low movement, high movement, like those things are at least
Strong.
penciled in, right?
Yeah.
Okay, so now, you know, if you were to read a headline, it's people want to move.
Yeah. Yeah.
They might have had 4 kids since 2020, right? Or their 4 kids left the nest. Millions of reasons why
Mhm.
people are doing this. Now they don't want to because interest rates are too high. So now it's like a game of what?
Yeah.
Roulette?
Chicken.
Perhaps, you know, like who's going to move first? Who's going to blink? For you guys, you've got all the brains, you've got pretty good data, and you've got historical context. How far around the corners do you like to look? How do you do it? And what is your like predictive analysis?
Wow. How much time do we have? Can I get a PowerPoint and some spreadsheets? Okay. So I think if you take a step back, I think you just simplify everything you possibly can. And it comes down to supply and demand.
Yep.
Right. Demand, depending on Fannie Mae or Freddie Mac or you know, one of the biggest banks, there's somewhere between 5.5 and 7.5 million single family units of homes that need to be provided, whether new construction or resales.
Yeah.
That's how much demand. So think about that, right? That number will only get bigger as more people graduate high school and college and go into the profession, have babies, right?
Yeah.
So the demand is really, really strong. So long term, really, really bullish on homey and the real estate sector and mortgage and all that. And then you look at the supply, then you're like, that's the problem, right? And then you look at the cost of capital, which is continuing to rise. I think if you read a lot of headlines now, where we're sitting at, you know, sort of early May, I think we've peaked where interest rates are going to be, and then they're going to start tapering off. You know, the mortgage banks have already priced in that sort of last rate hike, and hopefully that will happen, all other things being equal. Then you look at unemployment, right? Still 3.5%. And be like, yeah, Mike, but the participation's low. Yeah, but low, but rising now, right? Which is starting to normalize certain things. And then you kind of take a step back and say, okay, we're going into Q2, Q3, which are the biggest sort of quarters for real estate.
Yeah.
And no matter what, right, that bell curve, it's going to happen. They're going to increase, right? And then some choppiness here and there because it's transactional. And there's still a bunch of people moving into Utah, right?
Yeah.
A lot of people moving into Utah. So that demand will still be there. And for a consumer, you have to think about, okay, well, what can I afford? Right now, it's probably the best time to go get pre-qualified, and best meaning ahead of the process, right? The worst thing that can happen, you fall in love for a home, it's perfect for you, and you realize you didn't qualify. You know, you're going to spin your wheels, waste some time, and get a broken heart.
Yeah.
So getting pre-qualified and pre-approved is probably the best thing you can do. And if you think about, okay, am I going to be here 5, 10, 15 years? Is this going to be a home for me, or is it an investment that I'm going to try to flip?
Yeah.
Then your angle is very, very different, right? We just bought a home. It's 4 or 5 blocks away from our kids' elementary school. Our youngest is 2. That school is amazing for us and our family and the community. It's a great school. You know, Zeke's going to be there. We're going to be there 10 years from now, right? So for us, that's what mattered. Was it expensive? Yeah, it's crazy, but that's what worked for our family. The cost of capital, yeah, that's what worked for our family.
Yeah.
And with the rebate, you know, we're able to get a good deal on it.
Yeah.
You got to look a little bit more long term for what your needs are, and then whatever goes up must come down.
Yeah.
Whatever goes down must come up, and those are the interest rates, right? In 12 to 14 months, it's going to be a little refi boom, right? And the cost of capital for me and others will go down.
Yeah.
You know, so that's what I think will happen. I think we're starting to thaw out a little bit more. You know, more people are starting to say this is our new normal, right? This is our new normal.
Yeah.
When psychology shifts that way, in my opinion, that's good, because then that's where the normal is, and we can kind of stop having the whiplash and the effects of like, inflation is this, or, you know, inflation is that. It's our new normal, and then we kind of move on from there. And I think transactions soften up, cost of capital, you know, softens up, the economy gets a little bit stronger, the fundamentals, you know, stay strong, and then I think we start getting into a more normal market.
Yeah.
Yeah.
The whole thing's pretty interesting that it
Yeah.
usually works out, right?
Yeah.
And you can always kind of tell when you're talking to somebody about real estate or just houses, if it's transactional, they're looking at it from like a deal perspective. And I'm like, there's probably better ways to make money. Or if you're talking to somebody, I just want like a place to be happy
Yeah,
and have fun.
that's right.
And then it's like, doesn't matter as much, right? Like if you want a place for memories,
That's right.
yeah, the numbers might not have been perfect, but ultimately who cares? And it's just this broad spectrum of what people think and care about
Yeah,
as it relates
that's
to
right.
like four walls and a roof,
Yeah,
right?
yeah. And I think that's what consumers, that's what we have to think about, right? Are these four walls and the roof good for me? You know, is it a little bit more expensive than now? In the long term, right? All other things being equal, real estate generally appreciates, right?
Hmm.
And if you go into it like, okay, it's a long term, it's a home, right? It's a home for me and my family, and that's what our needs are fulfilled by this. Then I think that's great. But if you're so conscious about flipping it and making a dollar, yeah, it's more risk, right, in
Yeah,
the near term.
you're paying attention a lot more to the
Yeah, for
numbers,
sure. Yeah, for sure.
and you're probably either euphoric or frustrated,
Mm-hmm.
depending on
Yeah,
it
that's
when
right.
you decided
Yeah.
to call it. Um, okay, so you guys are watching a lot of things,
Yeah.
and you're probably not as surprised when things happen as others. But do you have like games where if this happens, we'll do these three things. If this happens, we'll do these three things. What is like your triage for all these things outside of your control?
Yeah. So scenario modeling, right? There's your base case, there's your bull case and your bear case. And right now the base case is kind of like a bear, right? And then the bear is like, holy crap, if that happens, it's scary from time to time, right?
Yeah.
One of the things that I learned in real estate is nothing ever goes to zero. And there's
Yep.
certain principles that always apply. And for me and for the business now is you got a list to last, right? If you help sellers gain that inventory, we only charge $3,500, which is so cheap. And you attract buyers and you're able to make a market. You meet that supply. If you start with the buy side, you're kind of tied to whatever the inventory is out there. So what I did at the beginning of the year and with the management team and the board is, okay, let's model out what we think is going to happen in 2023. Let's discount that by 20%, and let's see if we can get our market share that we've averaged over the last couple of quarters, right? Maybe not the last 2 years, but 2 quarters,
Hmm.
and say, how lean can we be? What are the minimum things that we need? How can we change compensation structure, make it maybe a little bit more variable than fixed? And the sacrifice that everyone has gone through and the commitment has just been, I mean, gosh, people cashing their 401k so they could survive and help Homey fulfill its mission is just humbling.
Yeah.
Man, it's crazy. I'm humbled by it. It's pretty amazing.
Yeah.
But yeah, we just go through those scenarios, right? These are the things that can happen, and just make sure that that the line is long enough for us.
I bet it is fun.
Oh man, fun is funny. It's fun to go through scenario planning. Going through 2022 took the fun out of it, right? Because now you're just not looking at spreadsheets and models. You're looking at the human beings and the names and
Yeah.
their families.
Yeah.
And their kids and their personal situation and their health things. And it's just, yeah, it's not fun anymore when you do that stuff. It becomes really real. But I think that empathy gained, we're very thoughtful about the bets we're going to make and where we are not going to focus our times.
Yeah. Let's just talk a little bit about Utah, right? Because you've got, there's a huge argument about real estate all the way from like, not in my backyard to we
Yeah.
need more
Yeah.
housing on the tracks. We hear it all.
Yeah, yeah.
And there's too many people moving in. And then somebody will say, well, the real problem is nobody wants to leave.
Yeah.
Whatever, right? It doesn't matter for you guys. You're going to roll with the punches.
Yeah.
How different is this market versus some others that you've possibly looked at or are currently in? And
Yeah.
how do you adjust your strategies?
Yeah, so we're really lean in our outside markets, right? What we've learned that we can execute is on a hub and spoke model, that we can have, a lot of our loan officers and title and escrow officers and insurance producers from Salt Lake City, and then, manage all of our markets from that. We do have, and what we learned, we need real estate agents at the local level because real estate is hyper local, right? We have to have them there. And we've proven that our attachment rates have only gotten stronger, which is really, really cool. You draw things up in a model and a whiteboard, you hope that they work, right? And hope is not a strategy. So you deploy on that, you adjust. And that's been really cool to see how the teams rallied together around that piece. So the markets are really lean. As a matter of fact, on a combined basis, they're all profitable.
Okay.
That's so cool. That was a soundbite.
That's happy. Happy sounds.
And that was really, really cool. And it literally took every single one of our homies to get there. And we're not done yet, right? Now we want to go through consolidated, profitability, and we're marching towards that piece. And just keeping it really lean. What's a necessity? What's a nice to have? What's noise? What's signal? Make sure you're paying attention to the signal and kind of scenario planning, right? Quarter to quarter, month to month. And if you needed, week to week.
Yeah. Yeah, that's not fun if you got to do things week to week.
It's not.
No good. All right. So we're now here. And you've mentioned kind of in your prognostications forecasting, there's going to be a thaw and a little bit more predictable from what you guys can do, right? And if you're listening and you're interested in a house, there's also some tidbits of free advice and information there.
Absolutely.
Courtesy of Homie. As the ship rights and, you see it further in the back or in the rearview mirror. And by the way, good riddance to the last 3 years.
Oh,
good
especially
riddance.
2022.
Yeah.
Thank you, but no thanks.
Yeah.
And goodbye.
What is the end game for you guys? Is it acquisition? Is it you guys are just going to do this until you're 60? You're going to IPO? Or do you not even worry about that stuff yet?
I'm not even thinking about that. For us is fulfilling our mission and the vision of Homie, and then focusing on, profitability, customer service, leveraging technology, efficiencies. Focus on those things, and then everything else will fall into plate. It always has, and it always will, right? When I was young in my professional career, Alan Hall was kind, and he's a legend here, and one of the kindest humans I've ever met. He said, Mike, you will do well by doing good.
Mm-hmm. Yeah.
Do more good.
You'll tend to your knitting and you'll worry about the rest.
Absolutely.
Okay. So there's the macro world events.
Mm-hmm.
There's stuff happening in America, stuff happening local. All quite a bit different, different game plans. And then there's what's happening inside the walls of Homie, right? And then there's what's happening to you.
Yeah.
And you've already mentioned that it was not fun. It was emotional. It was very hard. Ultimately, decisions need to be made. I imagine the last 3 years might have felt like 30 for you. And there was probably some new things that you'd never done before. And you had to adapt on the fly. What are some of those that you obviously don't want to repeat, but that you can give some sage advice and counsel for those that might have to do it at some point in the future?
Oh man. All right. That's a good one. And if I can share any of my experiences and hopefully be helpful, or if anyone wants to call me or email me, mikep@homie.com, and share an experience or something that I could be helpful, I feel like it's a duty, especially and specifically to the Utah community, because they just have been so supportive. And I've never seen anything like it. I've lived in New York City, I've lived in LA, I've lived in Las Vegas. I have never experienced something like that. And if I can be of any help, happy to do that. I think the one thing is you have to surround yourself by good people, both professionally and personally. And there's no way I could have done this without Mallory. She's as much a co-founder of this business as I am. She is my rock. She's been there for me. She has seen me curled up in the fetal position, and she's asked me questions that help me take a step back and kind of realize what matters, right? There's lives behind our employees. There's lives behind us,
Mm-hmm.
And remember we played this game one time, and she's like, what's the worst thing that can possibly happen? Obviously shutting down Homie. And we went through this iteration over an hour, 4 a.m.
Mm-hmm.
And I said it out loud, and it broke my heart. But it wasn't the end of the world.
Yeah.
And I'm sharing this really personal. Homie is so much of me. It is professionally, it's why I'm alive. And my wife and I and the management team and our investors are so in this together because it's worth fighting for. So those people that you surround yourself are super, super important. Some people adapt to stress and pressure differently. Do your best to try to understand that. I have to go to the gym in the morning. I have to be in my own space and work out and get all the frustrations out. I have to wake up early. I have to rise before the sun. That for me energizes me. And what I've learned is my wife also has certain pressures and stress, and I need to understand those. I need to share more. I need to be more vulnerable with her. That only makes that relationship stronger.
Mm-hmm.
With the board is being real and honest and saying, hey, this is what I think is going to happen. I don't believe that that's going to be true, or I do believe this is true, and here's why. There's I was in a conference the other day, and there was an entrepreneur that asked, how much transparency should I share with my board? And I said, look, you should not look at your board as this like hierarchical thing that you report to and they're your boss. Like, they are there to help you. And the sooner you realize that and the sooner you leverage them, the more progress you'll be able to achieve in performance and communication. And how much detail is up to you, but always be transparent and honest, because they have experiences and they can help, right? So that's one. Number two is transparency. And transparency comes with the strong stomach, right? People think that they want transparency. And, at our management level, we super transparent. They know everything. And it came at a cost. It shook some people,
Mm-hmm.
but it did not shake them enough to say, hey, I'm going to leave. And that's something that I remember going around the room with every single one of our senior managers. You don't have to be here. I will help you land anywhere you want to land. You don't have to be here. And they all said, I'm going to fight this fight with you. I believe in you and I believe in homie. And man, that was really cool. That's transparency. And I actually learned that from Ryan Smith long time ago when he was on stage. That was really cool. And now we apply it. And wow, people really, really welcome that opportunity. And I was a little bit paranoid about sharing too much.
Mm-hmm.
I think number three, from an entrepreneurship perspective, is if you sacrifice everything to build something, why? Why are you doing that? Why are you putting your kids through sacrifice and stress, and your spouse and partner and wife, etc.? Like, why is that? Don't forget why you did that. And don't forget why you do that.
Mm-hmm.
You'll compromise a lot of things, but once you start compromising that and why you started the business and what you wanted to achieve, you've lost already.
Yeah.
So I would say those three things.
I love it. Yeah, because in the fog of war, which you guys were in, transparency helps with the trust.
Oh, absolutely. Confidence and trust. CT.
Yeah. Absolutely. And if like that data point, right, like you need to work out and wake up early. And if I'm in the trenches with you, then like, okay, let's not schedule anything really important during that time. Even just like incremental, easy things like that add up, because you react differently when it's just chaos and the fog of war versus like, oh, well, look at all the money coming in. Completely different mindset. One's easier, one's harder.
Yeah, for sure.
So, well, very cool. This has been so fun because of your transparency. Plus, you can just drop like great little tidbits of psychology and how the world works as it relates to interest rates and real estate. And I'll be damned if like it just keeps trucking along and keeps on working.
Yeah.
So
thanks, homie.
thank you so much, Mike. Appreciate your time for both of these. Of a new appreciation for folks that have had to sit in your seat, and now I know what was going on behind the scenes. I appreciate.
And now everyone knows.
There you go. Thank you so much, Mike. Appreciate it.
Thanks, homie.
Yep.